Tuesday, July 6, 2021, Monaco 64, home of alternative economics and contrarian views. So today we're going to look at how a bullion bank analyst, of all people, is saying that buying gold is a marvelous way of moving away from the dollar. And we're going to look at how central banks are starting to move back into gold, buying gold in 2021, and how they're on pace to buy a lot more than they did last year. Before I start, though, I like to say that many of you over the years have asked, many that haven't bought gold or silver, that are interested in buying gold and silver. And I have to reiterate, I'm not here trying to tell you to buy gold and silver, but if you're going to ask me where you can get it, I'm going to tell you. And I always tell people, do your homework and get the best deal. But here in the UK, I have a couple of companies that deal in gold and silver and other metals as well. And one of them is Gold Investments. I have a promo code with them, Monaco 64. You get a small discount. And they will also try to match any price out there. And the other thing that they will do, even last year when very few people could find physical gold and silver during the beginning of the lockdowns, they had supply because they've been in business for so long. It's a family-run business. You can find their details below in the description of the video, Gold Investments. And if you do deal with them, use my promo code Monaco64. The other company is Glint. Yes, they're not bullion dealers. They provide you with a MasterCard and an app to buy allocated gold to be stored physically in Switzerland. And my referral code there is Mario Glint 79. It's also in the description if you're interested. So now back to the bullion bank analyst talking about gold and also about central banks buying gold. So what's going on here? Are the bullion banks finally going to start short covering their huge unallocated positions because of Basel III? Possible. But before we go into this story that came out on Bloomberg about central banks buying gold, I'm going to tell you one of my stories. Many of you know, of course, that I worked as a futures and options broker in the city of London for over 20 years. My clients were not private clients, they're institutional clients. What does that mean? Well, they're corporate clients, treasuries, they were banks, there were other brokers, there were mutual funds, there were hedge funds, those kinds of clients. And from around I would say 1993 to 2004, the bulk of my clients were based in Italy. So I did a lot of traveling to Italy, major Italian banks, fund managers. And I remember one of the banks I dealt for, they were based out of Rome, their headquarters. They're one of the biggest banks in Italy. And we just traded bond futures, interest rate futures. That's all we did. But once in a while, every 3 months or so, I had to roll over a short COMEX gold position, quite a big position in the hundreds of contracts. And at the time, this was probably back in the late 90s, early 2000s. I always found that strange that that bank had a position in gold. And the another interesting thing about that position is that I remember when the gold market got quite volatile, there is a change in margin, increase in margin, and this client got a call, that's what it's called, a call to send more money, which was going to be quite a bit because the position was big. And I was concerned about it. So I called my contact at that bank and I said, whoa, you're going to have to, they've increased the margins for gold. And this person, I thought was going to say, oh, really? We'll have to see what we can do. No, this person just said, oh, okay, no problem, and put the phone down. And I thought, wow, that's strange. she's not even concerned about that. And at the time, I thought, well, yeah, I thought that was strange. But through the years, looking back and learning about the gold market and what central banks do, I realized that they're probably holding this position for the Bank of Italy. So that's another thing. These banks, bullion banks, and granted, this Italian bank is not a major bullion bank, but they're kind of acting like one there, having a short position, a pretty big short position in gold. We're probably dealing for the Central Bank of Italy. I have no proof of that, of course, because I didn't have access to their accounts. I had access, of course, to their accounts with us at the time I used to work for ABN AMRO Bank, but not to their private accounts in Italy, who were their clients, of course. But I suspect it was the Bank of Italy, because they were not concerned about the margin increase at all, and they kept that position. So that's how you have to look at the bullion banks as well. That not only are they dealing for what is called commercials or miners, I think a lot of their clients are the central banks. So let's get to the story now. You want to hear the story today, of today, not of 20 years ago. Gold regains shine after central bank buying drops to decade low. Let's go through this article. This is from yesterday on Bloomberg. It says central banks may be regaining their appetite for buying gold after staying on the sidelines for the past year. Central banks from Serbia to Thailand have been adding to gold holdings, and Ghana recently announced plans for purchases. As the specter of accelerating inflation looms and a recovery in global trade provides the firepower to make purchases. A rebound in buying, which had dropped to the lowest in a decade, would bolster the prospects for gold prices as some other sources of demand falter. Long term, gold is the most significant guardian and guarantor of protection against inflationary and other forms of financial risks. That's coming from the National Bank of Serbia. Serbian President Aleksandar Vučić recently announced the central bank intends to boost holdings of the precious metals to 50 tons from 36.3 tons. Bullion has come under pressure this year as higher bond yields made the non-interest bearing haven seem less attractive to investors. After recovering in April and May, gold fell by the most in more than 4 years last month as the Federal Reserve turned more hawkish and the dollar strengthened. Hawkish, right? They may be thinking of raising interest rates in about a year or two, while the CPI, of course, is running around 5% or 8% annualized in the last 3 months, and rates are still at zero. Is that really hawkish? But let's continue. The recovery in global trade is bolstering the current accounts of emerging market nations, giving their central banks the option of buying more gold. Higher crude prices are also boosting bullion prices by oil exporters, including Kazakhstan, according to James Steele, chief precious metals analyst at HSBC Holdings plc, one of the major bullion banks. That's likely to continue, he said. If a central bank is looking at diversifying, gold is a marvelous way of moving out of the dollar without selecting another currency, he added. So there you go. This is what I've been telling my viewers for years now. We've been doing this for over 5 years here on YouTube, that gold is a great way to get out of national currencies. It's a great way to diversify and protect your savings. and he's advising central banks to do this. In a bullish scenario, as the global economy rebounds, central bank buying could reach about 1,000 tons. Akash Doshi and other Citigroup Inc. analysts wrote in a report, the bank's forecast is for purchases to climb to 500 tons in 2021 and about 540 tons next year. That's below the twin peaks above 600 tons in 2018 and 2019, but a significant advance on the 326.3 tons purchased last year, according to the World Gold Council data. About 1 in 5 central banks intend to increase their gold reserves over the next year, according to a survey by the World Gold Council published last month. Central banks are one component of physical buying that's helping to counter hefty investors' outflow from exchange-traded funds, said Standard Chartered PLC's precious metals analyst Suki Cooper. Geopolitical tensions, the need for diversification, and heightened uncertainty have continued to buoy interest in gold reserves, said Cooper. So, yeah, and central banks don't buy ETFs. They don't buy futures. These central banks are buying the real thing, and that's what you need to do if you want to be your own central bank. So with that, let's quickly look at where the markets are this morning. It's 8 a.m. London time. We've got spot gold at 1805, so we're back above 1800. That's fairly significant because we've been in a range, it seems, for the last few weeks between 1770 and 1790 or thereabouts. So we've broken out of that. So gold is up $13 or 0.75%. The high has been 1807 and the low has been 1789. Silver is up 13.5 cents or 0.5% at 2660. The high has been 2671 and the low 2637. The Dow future is down 7 points. The Nasdaq is unchanged. The S&P is down about a point. To the currencies, British pound is up 0.33% at 138.90. The euro is up 0.25 at 118.90. The dollar is down slightly versus the yen at 110.87. And the dollar is unchanged versus the yuan at 6.46. The Aussie dollar is up 0.8%. So Aussie dollar is up quite a bit at 75.90. A look at the commodities right now. We've got crude up above $76 now. WTI crude up 0.5%. High-grade copper up 1.2%. Just below 440. I'm going to do a video later on today or maybe tomorrow about commodities because the general commodities seem to be moving higher now. We seem to be set for another leg higher, I would say, after the recent correction that we've had in commodities. We're going to look at lumber. Lumber is looking very interesting as well. So to finish off, a quick look at where the 10-year yield is. Well, we're at 145, up about 1.5 basis points. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.